Okay, so the first thing I'm going to talk about today is what your schedule looks like for Chance. We have got, I think, is it 7 more weeks of school? Roughly? Yeah. Okay, thanks. I'll take a look at it. Remind me at the end of class. So for Monday, next Monday, on 3/21, I'd like you to read the introduction to Champs and look over the chart of accounts. And the introduction is the first, it's the actual text here. So it starts on page 1 and it kind of tells you about the company, how it was established, who the principals are. It goes through page 5. It's okay. I'm sorry?
Are you on the schedule?
Yeah. Yes. Yes. So that goes through page 5. Then I want you to look through the chart of accounts. And really all I want you to do when you do that is to establish any, questions that you're going to have for me on Monday, like, what the heck do we use account number 114 for? So make sure to do that. Then also for Monday, I want you to set up a general journal, right? And a lot of people will still do it on the old-fashioned accounting paper manually, and some people are more comfortable doing it in Excel. I'm not going to see any of your backup work, so I don't care how you do it. It's whatever feels easiest to you. And then I'm asking you to make the journal entries from January 1st through March 31st. So you're going to probably, I would spend a good hour just kind of looking at the packet before you jump in. And then the journal entries start on page 14 for the 19Y4 transaction. So you're going to start on page 14, January 1st. I want you to make the January 1st through the March 31st journal entries. So that's 3, 4, 5, 6, 7, 8, 9, 10 journal entries. What you're going to find right off the bat is like, oh my God, I don't have any memory whatsoever how I journalize the trade of a piece of equipment. So you're going to have to go back and do some research in your accounting 2 chapters.
Can we put 2016? Okay.
Yeah.
No, it's totally from now January 2004.
No, that's fine. Sure.
Okay.
Sure. Yeah, absolutely. So, and then I said the first journal, and you will likely need to have your accounting 2 book close at hand. The very first entry is a reversing entry. It goes in and it says to us, record the required reversing entry for accrued interest. You probably never did reversals in accounting 1 or 2. All that's asking you to do is to go into your balance sheet, see if there's any accrued interest, i.e. interest receivable or payable, and make a journal entry to reverse the amount out of that account. So if it's a payable, how are you going to reverse it? Debit or credit? You're going to debit it. And then hint, what was the other side of the entry? So when you set up accrued interest, you need to figure out what the other side of the entry was, depending upon whether you find a receivable or a payable. And then I said, if you don't know how to do one of the entries, just leave a space for it in your journal and move on. Okay. The book, the key is in the library. So if you want to get going on those tomorrow and Friday, great. The book's here. If you don't get to it till the weekend, you're not going to have something to check. And just leave a space and move on. And don't, students will get like blown away. They can't move any further. It's like, are you kidding? You've got a lot of work to do here. So, I'm almost wondering, I think maybe you guys should try and get the journal entries done. Well, let's just do that. Because I want you to spend time looking at the case itself. So you've got the pages 1 through 6 that talk about it. Then you've got the chart of accounts. Then you've got the transactions. You'll see that what you're going to do in this project, you're going to do all the journal entries. for 1 year for 2016, whatever. And then you're going to do a worksheet. Remember the old 10-column worksheet? So you might want to get that set up and ready to roll. You're going to make adjusting journal entries. You're going to complete the worksheet. You're going to make do your financial statements. You're going to do your closing entries. And then you're going to move on and do the whole thing for 2005. And at the end, you're going to write a report that tells me and then you're going to do ratios on them. And then based on that, you're going to tell me how you think the company's doing, liquidity, solvency, profitability, and write a report on it. So that's basically, and I'm not going to sit here and read this all to you, but this is your schedule, okay? And you're going to definitely be, needing to keep pretty focused on moving through this project. You've got to be going into spring break through the worksheet for 2004 so that you can do your P&L and balance sheet over spring break. And you can see all this. So I'm just going to post that, or it is posted on Moodle. And this is kind of your Bible as far as schedule. Okay. So let's start on, or continue on rather, with the corporate review. And let's see where we are. I think, I know that we finished the stock register on Monday, right? Where we did the cash dividends, stock dividends, and stock split. I think we're starting on the bonds payable issued 800,000 of 10% 8-year bonds at 97 on May 1st, 2010, the day the bonds are issued. So I'm just going to walk you through these. Did everybody have a chance to take a look and kind of get a little bit of a refresher on discount and premium bonds? So let's see where I'm at here. So the first thing that I want to ask you when we're making this journal entry is what does that mean I issued the bonds at 97? 97 what? So it says I issued bonds at 97. That means that I issued them at 97% of face value. So maybe we should actually, let's even back up just a second and let's talk about some of the terminology. Okay, so this is a bond. This is called face value or maturity value. And what that means is that's the amount that you're going to get paid at the end of the life of the bond as the bondholder, right? Why am I issuing bonds as a corporation? To borrow money. Okay, I've got two options. Or three options really. I can generate it through operations, I can sell stock, or I can issue bonds. When I issue bonds, what am I doing? I'm borrowing money at a stated interest rate, right? For a term. And I'm going to pay you interest based on the face value. So how much interest am I going to pay for a year? How are you going to calculate that? Principal times rate times time, right? The principal is fair value, face value, or maturity value. And if it's for a whole year, my time is 12 over 12. right? That's for 6 months, it's 6 over 12. 3 months, it's 3 over 12. So I'm essentially paying $100 a year on this bond. But then there's a little bit of a loop being thrown here, which is this bond was issued at 97. What does that mean? It means at 97% of face value. So how much cash did I get for one bond? That's it, right? Face value times the percentage. So what's actually happening with these bonds is you guys are giving me $970. For 8 years, I'm paying you interest at 10%. And at the end of the life of the bond, I'm paying you back $1,000. Right? You give me $970. I send you checks for $100 a year for 8 years. And at the end of the life of the bond, this is the maturity value. So is my interest rate really 10%? Because what's this other $30? No, because you guys are giving me $970 and I'm paying you back $1,000. So, okay, it looks like it'd be a gain or loss, but you can't have gains or losses on your own debt instruments. What it really is when I went to issue those bonds, the market interest rate was doing something higher than my bonds. Like the market was paying 11%.
So you had to sell them at a discount.
Who's going to buy my 10% bonds? Nobody, because they can get 11%. So I have to discount it, and mathematically, using present value tables, that $30 over 8 years exactly takes my interest rate from 10% to 11%. So a discounted bond, the market rate is higher than the stated rate. Okay? So now let's go back up here and see if we can figure out what we think the journal entries are. And I'm going to put them in the order that I want you to do them. So the first thing I want you to do is figure out how much cash you think I'm getting. How much cash do you think I'm getting? So figure that out, that's your debit. Secondly, bonds payable is always, 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 just like stock is always at par, bonds payable is always at par. So get me your debit to cash, get me your credit to bonds payable, and then plug the difference to the discount account. Plug the difference to the discount account.
How many bonds does it cover? 80,000. 80,000. Supposed to be that much.
So how much cash do you think I got? 776, right?
Right,
What goes in my bonds account?
800.
Yeah. So what's my plug to discount?
Is it still the APIC?
No, bonds does not have additional paid-in capital. The plug number or plug account for bonds is either discount or premium.
Well, and that's discount.
Yep.
Debit.
And what this discount really is what I just illustrated down there on that timeline. That's really part of interest expense. Because they gave me $776 and I'm going to pay you back $800. So in addition to the 10% a year, I'm also coughing up another 24 grand. This account is a contra liability. It goes against your bonds payable in the long-term liability section of your balance sheet.
The discount.
Because it's got a debit balance. We are going to amortize bond discount to bond interest expense over the life of the bonds. Amortize means to write off. So that's what happens on the day that we issue them. Then we go down the road on November 1st, and we make our first interest payment. Three things are going to happen. What's one thing you know on the date that I send the checks out? You're going to have to figure out how much you paid. And we just did that together. Principal times rate times time. So figure out how much cash you're paying. And don't forget, the key word here is this is a semi-annual interest payment. So what's my T going to look like? 6/12. Yeah. I think what you have to do is figure out principal times rate times time, and that's the number. So my principal is the face value, my rate I gave you, and we know what the T is. Times 0.1 times 6/12, right? It's 40,000. Huh?
Oh, semi-annual.
Semi-annual, every 6 months. That's the first thing you have to do. The second thing you have to do is what I was just asking you, which is amortize the discount, which means to write it off. So if you're going to write off the discount, are you going to be debiting it or crediting it?
Discount the contra liability as a debit.
Yeah. Yeah. It's got a debit balance. How are you going to write it off? You've got to credit it, right? You're going to write off the balance on the discount account over the number of interest payment periods. So make that entry. You're going to write off the discount over the number of times you pay interest over the life of the bonds. So you know how long the bonds are, and you know how many times a year you pay interest. It is,
No, I'm sorry,
the discount's 24,000.
I put too many zeros in.
The discount's 24,000. How many times am I paying interest over the life of the bonds? 16.
I want to do
24,000 divided by 16. So this is always the order you do this in. And make sure you've got that. You put it against your cash. Then you amortize your premium or discount. And your third number is the plug. And of course, this is bond interest expense. Of course, because that's what I'm doing. And you should see why the amount of the money that I sent in the checks is different from the amount that goes through my P&L. Because this discount is being amortized over the life of the bond. So that was the day that I actually sent the checks. Now I go down the road and it's the end of the year, 12/31. Record the accrued interest, including bond discount amortization. Same accounts, other than I'm not actually writing a check, so what's my credit going to be to if I'm accruing interest? Yeah, it's a payable. Yeah, bond interest payable. So let's get the account set up and then plug in the math. So on 12/31, set up your accounts, and then we'll plug in the math. And you should be able to do this calculation, bond interest payable. It's principal times rate times time. But think very carefully about what the T is. We just paid interest the 1st of November, and now it's 12/31. Okay, so do that math, and then also see if you can figure out how much discount you should amortize for 2 months. You have the credit, so you can plug it up. P times R times T. 800,000 times 0.1 times, what's your T? 2/12. Yeah. 800,000 times 0.1 times 2/12. How'd you get the amount for the discount? Well, we already know the amount in the discount, right? Yeah, okay, go ahead. How many months is it going over? how many months am I writing it off over?
16 total over the life of the bond.
Okay, yes, that's correct. That's the number of interest payment periods. But I'm not doing one of the whole periods, am I?
So you're doing one period and then 2 months and then the other one 8, 12.
If I'm trying to break it down to months, I have to divide it and figure out how much it is per month, right? 8 years times 12 months. So I've got to divide by 96 months, and then I'm taking 2 of those. What you said, Jessica, is correct. Normally, we would just divide by 16 because that's the number of interest payment periods, but I'm not doing a whole interest payment period, am I? And then once you have that number, then you can plug the bond interest expense. So I ended up $500 discount amortization and a debit to bond interest expense $13,833.33. Then it looks like, what did I say, 6 years later? Oh, that's all I've got. Huh.
5 years later, we gained 400,000.
Oh, I see. Yeah. Okay, that was confusing. Redeem 400,000. So I'm redeeming what percentage of the bonds? Half of them, right? And I've gone down the road 5 years. Here's what you need to do at a redemption. In this order. First, pull off the face value. Is that going to be a debit or a credit to get the face value of the redeemed bonds off?
It'll be a debit bond.
Yeah, I've got to get the face value off, so I'm going to have to debit bonds payable, right? Secondly, you can't leave discount floating out there. So if you're pulling face value off, you've got to pull off the discount that's associated with that. So are you going to debit or credit discount? Am I going to debit it or credit it? Yep. Third, record the cash, right, because I'm paying money for them. And lastly, the plug figure, in other words, what do I do to fill in the blank, is to gain or loss on redemption of bonds. All this is fairly straightforward. How much cash did I tell you that I'm redeeming them for? What percentage am I redeeming them for?
Yeah, you said 400.
400,000 of them issued May 1st. I'm redeeming them for 101 In other words, 101% of face value. The only thing you're going to struggle with is how much discount do I pull off? How the heck are we going to figure that out? Redeemed them for 101, right?
Oh, right there.
I've got to figure out what, Sarah?
You have to figure out how much of the discount you've already.
Amortized. Yeah, not paid, amortized. Okay, I totally agree. What's the best tool that we have if you want to analyze an account? What do we set up? Yeah. Where do I put the plus sign on the discount? In other words, is it a debit or a credit type account? Okay, so set up your T account, please, and go ahead and put the beginning balance in it. And that's just off of your original journal entry. The next question is, how many times have I amortized the discount so far?
Or has it been 5 years?
5 years times twice a year, exactly 10 times. Each time I amortized it, how much did I amortize it for? And you can go back and look at your first journal entry we made there. 1,500, is that the number? Okay. So 1,500 times 10 times, I've amortized 15 grand of it. So what's my balance in the discount account right now? Am I pulling all of that off? No, okay, good. So now you've got all your information. Go make this journal entry. Pull off the face value of the bonds we're redeeming. Pull off the amortized discount of the bonds we're redeeming. Record your credit to cash for the amount that you're paying and plug your gain or loss on redemption of bonds. So did we have a gain or a loss, do you think? Losses are like expenses, gains are like revenues. If I've got a debit plug, it's a loss. Anybody have any idea where this goes on your financial statements? Is it going to be on your balance sheet or your P&L? P&L, because it's like an expense. But do you want it all up with all your operating stuff?
No, it'd be in the investment activities.
It's all that weird stuff at the bottom called other. Okay, good. Now let's move on to the next one, which is bond issued at premium. You know how to make this journal entry. But this time I issued the bonds at 103. Why are people willing to pay a premium for the bonds? Yeah, because my interest rate is higher than the market. See if you can make the journal entry for my $800,000 of bonds issued at 103. How did I get? I'm sorry, Perry. I just plugged it. I had 408,500 on my credit side and 400,000 on my debit side before that number. So that's my plug figure to make my journal entry balance. The next one, we're issuing the ones that for premium. So this time, instead of issuing it at a discount, I issued them at 103% of the face value. So the cash I got in is more than the face value. Pardon me. So how much cash did I get? What am I on? 5-1? 800,000 times 103%. I got 824. What amount goes in the bonds payable account always? Face value. So this time I have a plug to what? Premium on bonds payable. And tell me again why people paid a premium?
They're going to get a higher monthly interest payment.
Exactly. I'm going to pay them more than the market, but they gave me 824, and at the end of the life of the bond, I only give them back 800. So that 24,000 effectively takes their interest rate down to what the market did. Make the first payment for interest. Number 1, credit cash. Number 2, amortize the premium. Number 3, plug the difference to bond interest expense. And the premium is going to go over the number of interest payment periods, just like the discount did. And think carefully about whether you debit or credit it to amortize it. What times what to get the cash? What's the principal? Yeah. Times the rate, times the time. You're going to get the exact same number that you did before because that doesn't change the stated interest rate and the face value. It doesn't matter whether they're issued at premiums or discounts. Now, to amortize a premium, do I debit it or credit it? It's got a credit balance, so how do I write it off? $1,500. So this time my debit's to what? Right? Interest expense. Same entry at the end of the year to accrue interest. Same sort of entry to redeem the bonds. The last thing I want to do with bonds, and then we'll take a little stretch and delve into the investments, is let's start on this April 1st, where I issued $600,000 of 9% 10-year bonds. Oh, you know what? Let me just show you one thing here. Could you, if I asked you on this premium bonds, could you give me the balance in the premium account after 3 years? Set up your T account and get me the balance in the premium account after 3 years. How much have I amortized the thing over 3 years? Yep. divided by 16 payment periods. We amortize premium or discount over the number of payment periods. Right? 1,500 times 6 times. So the balance in this thing right now is 15 grand. I just want to make sure that you understand how this looks on your financial statements. So if right now I was running financial statements, what section would you expect to see the bonds in? Where do your bonds show up?
Investment.
That's when I've invested in other people's bonds. These I issued.
So would it be in your liability section?
Yes, what kind of liabilities?
Long.
Yeah. Hold that thought though, Perry, because the investment section is where I record the bonds that I bought. Okay. What do you think you're going to see under the long-term liability section? You're going to see the face value. And then, where does the premium go?
Would be right under the face value.
You have to
And
add
then
it.
discount,
Yep.
if you have one.
So in this case, it's a premium, so I add it. And just so that you know that this term, when you either add the premium or subtract the discount, is called carrying value of your bonds. And right now, they're carried on my books at 815, aren't they? If that was a discount, what would I do?
Then you deduct it.
Yeah. If it's a discount, you deduct it. If it's a premium, you plus it. DDPP, that's how I remember it.
Can you have both?
No, not on the same bonds. Because you either sold them above or below face.
But you can have like bonds that you sold
Sure.
at premium and then
Absolutely.
every set of bonds you sold at
Absolutely.
discount. Okay.
Okay, let's do this last set of bonds and then we'll have a quick stretch. April 1st, I issued $600,000 of 9% 10-year bonds. At face value plus accrued interest on April 1st. The bonds were dated Jan 1 and pay interest on Jan 1 and July 1.
My last one, I have a 40.
Okay, first issue here is, were these bonds sold at a premium or a discount? No, they were sold at face value, so they were sold at 100. But this is kind of a weird, well, it's actually not weird at all. It's totally how it normally works. Here's when I pay interest. 1-1 and 7-1, right? Every year. I date these bonds, and then guess what? You know, it's the middle of a political election cycle and all the craziness we've seen, and the markets are volatile. So you know what my underwriters tell me? You should really hold on to those bonds for a couple months. This is not the optimal time to issue them. So I do. I hold on to them, and I don't issue them until 4/1. On 7/1, I cut checks for 6 months of interest to everybody that holds them. But really, you should only be getting how many months interest? All of April, all of May, all of June, right? So you've really only earned 3 months. Stick with me here. So the way that it works is when you buy the bonds from me, you pay for the bonds, and you pay me 3 months of interest. Then I turn around and write you a check for 6 months of interest, and it nets out to what you've really earned. You give me 3 months of interest, and then I give you 6 months of interest, and it nets out in your pocket to what? The 3 months that you earned. about it. If you give me $50 and then I turn around and give you $100, what have you netted? $50. And that's exactly how it should work because you didn't earn 6 months of interest. Did you hold the bonds for 6 months? No, you only held them for 3. But you bought yours on 4/1 and she bought hers on 4/2 and she bought hers on 4/3. Do you think I'm going to sit and calculate everybody's number of days? No, I send everybody 6-month checks. So when you buy the bonds here, each of you have got to pay me for the difference between the last interest payment date and the date of issuance. So here we go. Here's what the journal entry looks like. Let's see, what order do I want to do this in? So first off, record the bonds themselves. How much is going into the bonds payable account themselves? Is there a premium or a discount on these? No? Face value. How much accrued interest are you prepaying me? Principal times rate times time. How much accrued interest did y'all give me on April 1st?
13,500.
That's what I got. 600,000 times, what's my rate? 600,000 times 0.09 times 3/12. 13.5?
13,500.
That's how much cash you gave me, so debit cash. You're paying me for the bonds plus 3 months interest. I throw that in the bank. And then when do I write my interest checks? When do I send out interest? Yep, so the next payment date is 7/1, right? How much do I send out in cash for my interest? Principal times rate times time.
For which one?
For all of them. I'm paying 6 months of interest on all the bonds, aren't I? Yep. I've got 2 debits. Anybody have any idea what they are? Have I just paid this? Have I just taken care of that? You gave it to me up front. Now I'm doing what? I'm giving it back. So I got to get that off my books. Yeah, and the balance is bond interest expense because I do have to incur an expense for the 3 months you held them, right? So this seems like a pretty tricky transaction, but it's really not. And this is really how it works. You never issue your bonds on exactly magically the date that they're dated. Okay, let's take a little stretch and just about 3 minutes, and at 10 after, or I guess, wait, yeah, it's 1:09 right now. At 1:13 on this clock, we'll start again. Little stretch.
Mr. President,
you just don't know how.
What are you doing? Fool.
They're just inconsiderate. I forgot.
What's your problem?
So grumpy, not talking to anybody.
So she's me last week?
Yeah,
Okay.
she's you last week. She's getting to where I'm going.
I will do that. I completely forgot about that. Thank you so much.
Okay, are you ready for more fun?
Oh, you mean there's more?
There's more fun.
It just never.
It never ends is the good news. So now we're flipping the equation, and this time we're doing the investing. We're investing in stocks. We're investing in bonds. What we just finished doing was we issued stocks and we issued bonds. Now we're on the other end. So let's read the transaction. Oh, first off, why do companies do that? Why do companies invest in other companies' stocks and bonds?
To strengthen their portfolio.
Yeah, they've got extra cash. They don't want it just sitting there doing nothing, so they put it in stocks and bonds. In the old days, you had some level of assurance you might make money on it. Now the market's pretty volatile. Who knows? But at any rate, so that's what's happening. So on July 1st, 2010, the Pohl Corporation purchased $200,000 of Hurley Corporation's 12% 10-year bonds. And the day the bonds are dated. And they bought them for $224,680. So based upon what we just learned, if Pohl Corporation pays Hurley Corporation $224,680 for bonds with a face value of $200,000, did they buy them at a premium or a discount?
Premium.
Yeah, they're premium bonds. So what's the market doing compared to 12% that Hurley's paying?
It's higher.
No, the market's
The-
lower.
No, the market is lower.
Yes.
They're getting paid more interest
Yes.
in the market.
The market's lower, so they're going to get those nice 12% checks every year. But they invested $224,680. How much are they going to get back? Only the 200. All right, so let's make this journal entry. So interestingly enough, we don't have a separate premium or discount account on bonds that we buy, only bonds we issue. So the full amount of the cash I paid all goes in to my investment in bonds account. So super easy journal entry. It all just goes straight into the bonds account. I don't separate out. I'm going to be amortizing that premium, and we'll see that in a second, but you don't actually separate it out. So that's pretty straightforward. Why this board just does that in certain areas. Okay. Where does that account show up in my financial statements? How long are the bonds?
10 years.
Yeah, so where do you think that shows up in my financial statements?
Maybe the long-term, like long-term.
Yeah, that's exactly where it is. It's going to show up in the long-term investment section. If I bought some like 90-day bonds, where would they show up? Yeah, current assets. Okay, good. Now what happens next? On 12/31, how often do these things pay? Yep, once a year. I just bought them on a July, so I don't get my first check until the next July, right? So on 12/31, I've got to accrue what? What do I have to accrue?
Your interest that you gained over.
Okay, what are we going to call that?
Be a receivable.
Yes, ma'am.
Right away.
Bond interest receivable. So figure out how much cash not cash. Figure out how much you think goes into the receivable account after 6 months. We just started on the next section, Jess. Principal times rate times time, and make sure that you understand whether you're using the 200,000 or the 224,680. Which one's the principal? Yes, just the 200,000. $200,000 times 0.12 times 6/12. Did you guys all get 12,000? Now, everybody get 12 grand? Okay, so now tap into this because this gets a little confusing. Was there a premium or a discount on these bonds?
Well, actually, no, it was a premium.
Yeah, there was a premium. Of how much?
24,680.
Yep. What do we have to do with premiums and discounts over the life of bonds? Amortize them. I know that's a tough word. We have to amortize them. When we issued bonds, we amortized them to bond interest expense. But now that we bought the bonds, we're amortizing them to bond interest revenue. Am I going to debit or credit? So where is my premium? Is it in a separate account? You're looking at it. Where is it? It's right in the investment account. So you're amortizing the premium by doing what? Debiting or crediting investment in bonds? Crediting it. Same thing we did before. Figure out how much you should be amortizing per month and then amortize it for the appropriate number of months. How many years are the bonds? 10? So how many months are they going over? 10 years times 12 months, right? And how many months am I amortizing right now? Right? So, I got $1,234. what's my plug to? I'm getting a check for 12 grand, but I really got to amortize the premium. What account am I plugging? What am I earning by investing in the bonds? Interest what? Say it. It's right on the tip of your tongue. I can see it.
Interest rate.
Yeah, bond interest revenue. Because basically what's going on, I'm getting 12 grand, but I paid $24,680 more than I'm going to get back at the end of the life of them. So am I really earning 12 grand? No, I'm earning 10,766 because the market rate is less than the 12% my bonds are actually paying me. On January 1st, they ask us to make a reversing entry. I'm not going to actually sit here and explain why we do this. I'm just going to tell you how to do them. You've probably never seen these before. Usually they're automated. A reversing entry, you guys. Okay, first off, can somebody answer the question to me? Why did we make this entry on 12/31 if I didn't get any cash?
To keep track of how much we're earning.
Thank you.
To know where we're at with them.
And to get it in the appropriate year, right?
Right.
GAAP tells us we have to match expenses with revenues. Okay, this whole entry was simply done to make sure that I got that portion, that 6 months of interest revenue into the appropriate year. On 1/1, you're going to reverse that entry, which means you're going to credit your debits and debit your credits. And then when you go and actually get the full year of cash on June 30th on the interest payment date, it's going to net out against this to make 6 months. So on 1/1, reverse what you just did there. Just manually go reverse it. So, reversing entry, nothing magic, just make it opposite. Now what happens on July or June 30th? Debit cash for what you got. Record 12 months of amortization. And plug bond interest revenue. Debit cash for what you got. It's a year worth of interest. Amortize 1 year of premium. And plug bond interest revenue. So how much cash did I get? In total? 24,000, right? 200,000 times 0.12 times 12 over 12. 12, what did I just say? 12,000? No, 24,000. Okay. How much of the premium am I amortizing? Anybody? Did you get 2468? Is that a debit or a credit?
I did it as a credit to investment.
Yeah, because that premium is sitting in there, isn't it? We don't have a separate account. The plug is to which account?
Bond revenue.
Yeah, bond interest revenue. For 21,532?
Yes.
How much, you guys, and hopefully this will help you understand reversing entries. How much revenue shows up in this year? Take a look at what that reversing entry did to your revenue account. What did that do? It didn't close it out. I just made an entry for 21,532 of bond interest revenue, but what did my reversing entry do to my revenue account? Yeah, it lowered it. Because the full year doesn't belong in there, does it? Only the 6 months. So reversing entries just help us get what belongs in certain periods in the certain periods.
So since we did this on July 1st, so it's just that first year that you only have to do the 6 months.
No, we're going to go through the whole thing. On 12/31 of this year, we're going to accrue, and 1/1 of next year, I'm going to reverse. And 12/31 accrue, and 1/1 reverse.
But if you have versus them on the 1st of January, you can only do it once.
Yes. Yep. Okay. Let's go ahead then to the very last one here on Poll before we jump into our very last topic. Poll sold a half of the bonds for 104. The carrying value of on the bonds on the date was 217,276. All right, let's kind of tear that apart. Poll sold a half of the bonds. Why would Poll Company be selling half of the bonds?
So they can get money.
They're going to make some money. They're selling them for 104, aren't they? So how much cash do you think they got? Tell me how much cash you think they got. They sold them at 104. They sold half the bonds. How much did they get? Yeah. What do you think you're going to have to pull off the books?
So how did you come up with that?
So you have to take off
How much am I pulling off the books? You know that we always have, I'm sorry, go ahead.
you have to pull off the face value of the bond.
But can you leave any premium sitting in there? can't just ever have straggling premium or discount without any bond to attach it to. So if I sold half of the bonds, what do I need to pull off? Yeah, got to pull off half the number that's sitting in the investment account. The plug is to gain or loss on sale of investment. So pull off half of the bonds. The plug is to loss or gain on sale of investment. So do I have a debit or a credit plug? Yeah. Is that a gain or a loss? Yeah. I paid a premium for these things, didn't I? And even though I sold them above face value, that premium was so steep that I haven't even recouped my cost, have I? Okay, last section. Then we're done with our corporate review. The last section, we are investing in stocks of other companies. Anybody remember anything about this from accounting too? Okay, quick refresher. When you invest in stocks of another company, you've got two sets of questions to ask. The first set of questions is surrounding what percentage of that company's stock are you buying? Does this look familiar? If you're buying 0 to 20% of the other company's stock, it's purely for an investment, and you account for them using the cost method. No big deal. You throw it on your books at cost. So the investment is recorded at cost. And when you get dividends, you're going to debit cash and credit dividend revenue. No big deal. Pretty straightforward. And when you sell them, you pull them off your books and record a gain or loss. Super straightforward. If you buy 20 to 50% of a company, though, that's really not just to make an investment. That's because you've got some strategic reason for doing it. Like you want to vertically integrate, or you want access to their raw materials, or they're going to potentially be a competitor. That's what all the tech companies do now, right? They just acquire little tech companies rather than bring their own in-house talent. So you're not buying it as just an investment to park your cash for a couple months. You're buying, and you've got, so 20 to 50% of the stock, and you have something called significant influence. In other words, you've got a seat on the board. Then you don't use cost method. Then you use the equity method. and that's different. The equity method is like you really bought a share of that company's retained earnings. So here's how it rolls. You record the investment of cost, same thing. At what you paid for it. But you got to put it in a separate account from all your other investments. And it's going to say, right in the account title, it's going to say, whatever company. Equity method or something. It's an asset. It still goes in your long-term investments. But what you want your shareholders to know when they're reading your financial statements is, this isn't a company I just got a couple shares of. I've got 20 to 50% of this thing, and I exert significant influence. Secondly, at the end of the year when they declare their net income or net loss, in other words, when they run their P&L, you have to record a share of that because you really own part of the retained earnings.
So if you own like 20% and you pay 20%,
Yes.
then they're in their loss or their gain.
Yep. So you're going to record an increase or decrease in your investment account. For net income or loss. And this is all in your book. And lastly, when you get checks for dividends, you got cash, great. But their retained earnings just went down, so your investment account goes down. So you're going to record dividends. As a debit to cash, right? Because you got cash. But the credit is a decrease in your asset account. Okay, let's apply this to these cases. In the first example, on January 1st, the Shelley Corporation acquired 10,000 or 100,000 shares of common stock of Bird Corp for $190,000. In the first set of situations, assume that the 100,000 shares was 15% of the voting stock. Record the investment. Record the investment. Okay, so that's pretty straightforward. Debit, investment in Corp, or in Bird Corp stock. What kind of account is investment in Bird stock? It's an asset, right? And I pay cash for it. Okay, then the next thing says they declared their net income for the year. What do I do? Am I using cost or equity method? Cost. So do I need to record anything for the net income? No. The next one says record the journal entry for the receipt, or I'm sorry, Bird paid a $40,000 dividend for 2010. Did I get all of that? No. So record the receipt of dividends for the portion I received. $90,000 times 15%? No. 60,000 times 15%. Right?
I thought it was 40,000.
40,000 times 15%, $6,000. So that's it. Super straightforward. When you own 0 to 20%, no big deal. But in the next situation, it asks me to make the same set of journal entries, except for now you're assuming what? Yeah, that those 100,000 shares are 40% of the outstanding stock. So make a debit to your investment account, same. And then I'll help you do the next two.
Sorry, which one was it?
So we're doing the same one again, but it says, now assume that the 100,000 shares was 40% of the voting stock. So now we've got to use the equity method, don't we? So the first journal entry for the equity method doesn't look any different, does it? What happens though in the second example?
That's part of your, that's
Recorded, Bird reported net income of 75,000. Is that going to increase or decrease my asset? Right, so am I going to debit it or credit it? Yeah. For your 40%, right? Wait, yeah. 30,000. So my asset just went up, right? Because my equity in the company just increased because their retained earnings just went up and I own 40% of the retained earnings. My credit is just to a revenue from stock investment account. not cash, but it's something I earned. The last thing that happens is I get dividends. Record the cash. How much cash did I get? And then they've liquidated a little bit of their retained earnings, so you're going to have to credit the investment in stock. So Bird paid $40,000 of cash dividends. Record my share of that, and then the credit is actually to the asset account.
Is it credit the investment?
Yes. So how much cash did I get? 16. Okay, the only other thing in this packet, and I'm just going to point it out to you, we're not going to really per se do it right now, but remember yesterday or Monday we were learning about the appropriations? You're going to have to do some appropriated retained earnings, and I just want you to see what an appropriated retained earnings statement looks like, and then how it shows up on the next page in the balance sheet. And there's nothing fancy there. So for Monday again, you're going to read through Chance. You're going to do the first journal entries from January through March. Just kind of get your arms around this project and make sure that you have, if you flagged what accounts you're not familiar with in the chart of accounts, so we can talk about that first thing. Okay. I think you should probably also set up your stock register and get your beginning balances in. You bet. Have a good weekend.
With the, when the report in net loss, with that goal,